All right, everybody. Hello. How's it going? We're getting into the mirrors here. Time for some more tape reading. Last webinar, if you didn't get a chance to catch the last one that I did, we actually entered the matrix and we talked a lot about tape reading and checking out some different things on this one. I want to add a little bit. We're going to piggyback off of that. We're going to hit some more areas and hit some examples. I'm also going to close a couple of gaps for some of the newer members. There were a couple of emails I got about some of the information they received. They'd like some clarification. Going to try and roll some of that back in here. Hey, Island Girl, welcome. Good to see everyone. Awesome. Oh, thank you very much. Let me go ahead and get that out of the way. Thank you very much for that. That's handy. Gazoo, appreciate you, brother. The great Gazoo. All right, here we go. First off, legal jargon. Jargon away. I will leave it here for 10 seconds. Feel free to jargon. All right, we have jargoned. Okay, so for me, it's me with hair. My name is Thor Young. For any of you who do not know me, I'm a moderator right here at Bear Bull Traders. I started off pretty much the same way as I think everyone else in here. I actually come from an IT background, and I was drawn to the freedoms that trading could offer for me and my family. So started doing that a little over 4 years ago. I was actually driving Uber when I heard about the Robinhood app on the radio. Ended up trading with the Robinhood app for a couple of months. Actually made a couple of bucks, and my wife bought me a trading book. So the wife steps in and kicks it up, and thanks to her, I ended up finding an entire new career. So after time, I ended up being offered a mod spot to do some YouTube videos and start helping out. And we've kind of moved that forward into mentoring, moderating, and all this other cool stuff. So really appreciate all y'all because y'all make it happen. And because y'all make it happen, I like bringing the good stuff to you. So without further ado, in this webinar, we're going to be talking about our tape reading skills that we began to develop in the prior webinar and add some finesse. I often make a comparison when teaching the tape, that is comparing the level 2 and order flow to what I call the mirrors, right? When you're driving down the road, right, you never change lanes or change directions without looking in your mirrors. In a similar fashion, you should never trade without checking your tape. Your tape is being your level 2 and your time in sales. So over the next hour-ish, I'm going to walk you through a detailed breakdown of the level 2 and tape, a little bit more in there, and we're going to distinguish the nuance between bullish and bearish level 2s to help you isolate directional bias. So during this, we're going to add focus to supply and liquidity levels that will affect price movement. And in time with practice, you can begin to read bears and bulls making entries and exits. And I have a final example that I'll show you where we'll actually break that down, right? So, so it's a 45-minute trade that I'm going to go through, but I'll go through it in the course of about 5 or 10 minutes, probably. All right. This is what we're doing. So first off is just our basic level 2 layout, right? Level 1 is going to be your top area up here. This shows you your bid and your ask. Not too complicated. Your number 2 is your level 2, right? This is the moneymaker. DOS has one of the better level 2s out there. I configure mine, which I'll show you, for a very wide, very deep chart, right? Because I like seeing where the supply and liquidity areas are. Notice we have MMIDs. That stands for your market maker identification. This helps you see large stacks or groupings of orders, in particular price groupings, right? We have our books down here at the bottom, which if you're missing something from your level 2 will be most likely where you will find you are missing something. You won't have ARCA book, for instance, which is where your ACB and ARCA orders come from. INET bringing your NASDAQ, NSDQ and such, and then EDGX and others like that coming off of IEX. And I got that in there, Gusto. Tiers are the number of prices. So each price level is a tier, and that's based upon the spread. And you will see that going down here. And then color groupings, which are how you can group your colors. Now, this is a little bit of, it's a little crowded, but I wanted to make sure you guys got everything. So first off, this is how I do my colors. I actually just like using gray and light gray. The reason why is because I'm not really overly concerned with the with how the colors, having a whole bunch of colors, I really want to be able to look and isolate specific orders. So I want there to be a little variation because I want to be able to tell that there's different tiers, right? But I don't necessarily care, paint red, all the different things. So 2 is your price format. You can choose decimal or otherwise. Condition, which we condition on your level 2 shows you the flag code for that order. So not all orders that come in are orders that are of the exact same type of execution, right? So you can have a flag code R, for instance, which would show you something like an initiative or a initiation order, right? And things like that. So it's a pretty deep list, and not most of it really makes a lot of sense, but especially at NYSE, if you look at NYSE orders in the open with a flag card R, those things drop almost every single day when they do. So it's one of the main reasons I keep it there is actually for that. Hide market maker is number 7. We're near highlight whole roll, and then hide market maker. I actually hide CHX because they spoof. And then 4, these are our tiers. So if any of you don't have the deep level 2 that I have, this is where you get that set. I set my tiers to 150. 5 is where you can choose lots versus quote size. I personally like lots. 6 is you can choose the type of column. This is where we get our condition. 7 we hit. 8 is our monitor groups. If you want to monitor groups, like I monitor NYSE and GSO for the reason I just mentioned earlier. And quote size highlight. Now, quote size highlight, I'm going to take a second and I'll talk about this one a lot. One of the best features in DOS. This tool we're going to use to highlight large lots, and it draws your attention quickly to high value areas. You can select any color you want on here. But for me, of DOS, believe it or not, this highlight feature is one of the best things they've got in the whole platform. I know it seems simple, but before we had it, I wanted it. And when we got it, I was very excited about it. So let's just break down the basics real quick for anyone who's newer to L2. I want to make sure you don't get left behind during this one. So we talked about before on our level 21, we have our bid and our ask. Okay. The bid price obviously is going to be the highest price an investor is willing to pay, right? Or speculator. The ask price is the lowest price at which someone is willing to part with their shares, right? So the spread is the distance between the bid and the ask. Now, for most of you, I know this is basic, but the spread, it is very, very important, right, to pay attention to the spread here. And I actually need to change my prices here. Oh, no, I just use a generic stock and then use this. But you need to pay attention to the spread, especially for risk management. If you're a scalper, especially, and if you're playing tight positions, paying attention to spread is ultra critical because you can have a stock that can stop, but you take additional slippage because of the spread. So you need to make sure that you're really focused on stocks that have a spread that's appropriate for the price of the stock, right? If you're trading a $30 stock and it's got a 10-cent spread, that's going to be like trading Nvidia, right? It's going to be like huge slippage because you've got this very, very wide distance in between your shares. Now, you can get some really quick movements that way, but remember, we're not here for home runs necessarily. We want to get them if they set up, but risk management is key, right? The way you stop from blowing up your account, having all these things, is knowing where you're going to stop out. And if you're playing a stock with too wide of a spread, that's going to make that difficult. I leave the spread up on my montage. This is how. All you got to do is right click up at the bid ask spread and the drop down here. You can click on that. So what are lots? We kind of talked about this before. A lot is a grouping of all orders on a particular MMID at a particular price. So rather than see every single order that's out there on the L2, we use lots. We also use lots to lower the number of digits we have to read. Each lot represents 100 times that size. So for instance, at $28, you can see a stack of NSDQ with a lot of 320 and ACB with a lot of 180. That's a total lot of 500, right? So that equates to 50,000 shares sitting at $28, right? Now, this does not always mean that there's a very large seller at that level waiting to exit a position. Rather, it's every order from that MMID at that price grouped together in a lot. This way we can see the market more as a whole rather than getting bogged down, right, with too many individual orders. Now, I know in this instance, in the grand scheme of things, you think 50,000 shares isn't a bunch. However, I assure you of two things here. One, that there are more orders there. It is very rare for all of the orders that are intended to be transacted to be put out. Most large participants use icebergs. So generically, when you see a very large congregation of orders, there's more, right? Number two is that even 50,000 shares that are coming through on a 1 cent spread can tip the scale and imbalance the market makers, right? So I know it seems like it's not that many shares, but in reality, if your stock is trading 50,000 shares every time it moves 50 cents, and then all of a sudden exchanges 50,000 shares at 1 penny spread, right? That's an amazing amount of shares coming in at a specific price versus an amount of shares that are being spread out over a large price range, right? This is where our anomalies are really going to come in. You're going to see a very tight candle with a really high volume for its tightness of candle. This clues you in, and you're hitting a really large seller or pocket of sellers if that happens. So those groupings that we were talking about on 28, we call that stacks, right? So if you look down at $28, you see the 320 and the 180. We like to say, and you'll hear kind of the market lingo being, hey, we've got orders stacking at $28, right? So what we're referring to there is that we have multiple order sets coming in on multiple MMIDs, right? So this is a very, very strong level. Why is it strong? It's not just strong because it has a lot of orders. It's strong because it has multiple participants looking to exit or buy or whatever at that same level. This should really start to gravitate you to that order to see so many orders not only grouped but spread out on multiple. Sometimes that 28, you'll see it with 4, 5, even 6 different MMIDs sitting there. And it'll normally be like a 320, a 180, and then you'll have like 100, a 50, a 50, right? So the participants don't necessarily, MMIDs is your market maker's identification, and there are thousands of market makers, right? So participants are going to go to the market maker that they generically use. So for instance, if your brokerage, let's say you have your pension and your company's pension fund is held at Merrill Lynch, right? Merrill Lynch has a specific market makers that they're going to use to offload their shares, right? So they're the ones who are actually choosing which market maker gets to transact their shares. And it's their market maker's job to make the market and get those shares transacted. So why not colors? I think most of you remembered a little while ago, I had colors up on the screen and a whole bunch of them. And I decided that I was going to get rid of them. Chris, and many others of us have kind of just gotten like overloaded by the numbers. We got Brian W. actually had this idea first, and he sent me a screenshot. Hey, dude, I grayed out everything. What do you think? And I liked his, but I added in an offset color just to highlight the tiers a little bit differently. But I loved the grayscale because then when I put my pink highlight on top of it, it made it incredibly easy, right, for me to pause it. Ben, no. So unfortunately, there is a toggle that says less flicker, and that slows it down a very, very small amount, but no. That's the other reason why you want to use the highlight, right? Because what I'm going to do is I'm not going to focus as much on this. Now, I'll be honest, I'm comfortable enough with reading level 2 that I can glance and I can see without the highlight and see how it rolls through, but the highlight makes it so easy, right? But you can actually sit there and do that. So highlighting large orders, that's what I was just talking about. So, and basically what I'm doing here is I'm looking at these large supply liquidities. Obviously, in this particular moment, LSID looks bullish to me because I'm seeing a large order to the top side, right? And we're upticking. All right. So the next section is likely one of the most important things that you're going to gain from tape reading, and that is the ability to see the auction as it's occurring. So unlike, I'll just say chartists just to be fun, you aren't really waiting for a level. You're waiting for a change in the way the price is auctioning. If you recall from my market auction theory webinar, if you were able to attend it, we have 4 primary cycles, right? Value, balance, excess, and imbalance. Each of these phases occur, but only one of them is a trade that we can actually, or a phase we can trade. So value is price, and wherever the market is willing to perform the most transactions is where it will set value. Value is most often marked in the beginning by an unusually large transaction on the level 2, followed by elevated volume into large transaction set. So eventually, as the market agrees on value, the price will move into a degree of balance. In balance, you see you have an evenly distributed level 2. Just like in the auction, right? Balance will reflect the sentiment for buying matches that for selling. So if the bulls and bears have agreed that this is a good price, then business will occur here, and there's no reason to move. And this can show up as an empty level 2 or an overly full level 2, right? So as balance maintains, excess will begin to build on your level 2. And I'm going to show you some examples of that. Pockets of liquidity or pockets of supply will start to appear as participants begin making decisions. This is what our highlight feature is for, right? It's going to start highlighting those larger orders as they start to congregate together, right? Over times, they form those large of orders, and the excess becomes obvious in a particular direction. Once there's enough of it, the price will move in the direction of the orders as volume comes in. As volume comes in, excess turns into imbalance, right? This is the phase we're trying to trade. As imbalance sets in, the stock will go back into auction and it'll start searching for new value. Once in transition, it's most likely going to run the L2 in that direction until we hit another large order, right? That large order sets value, market agrees, we go back into balance. And we do that over and over and over again, right? As we trade. So the market being about balance between buyers and sellers, as they're constantly making decisions, new choices that move the price in one way or the other, but too much demand in any single direction, and that imbalance, right, gets created, and the market maker must move in the direction. So I put a little diagram together to try and kind of illustrate that. So the main perspective here is to have a perspective on what's happening, right? If you see green on the tape, who is participating? Are bears covering or are bulls buying? Both come in green, but one can be profit targets, one can be a continuation, the other can be a reversal, right? So as you're looking at the bear, the bears, you have to remember that bears, when they take positions, are short sellers. Bulls stopping out of positions are sellers, right? So when your ask is getting hit, right, and it's getting hit very hard, I know that it can be, I should have actually reversed this color to that side, but when the ask is getting hit, right, we have a lot of things that are going on with the ask, but it's very, very dependent on how the ask is getting hit, right? So if we have a lot of selling, and that lot of selling is actually coming over the price and it's transacting green at the ask, but it's doing it up here at the top, right? Then the bears are basically, we're stuck at limit, right? So we can't break up, but we can't come down. That means we're hitting heavy selling, right? So even though we're getting green, these are actually transactions by bears at the ask. As they come in short, they cross over and they hit the bid. And I'll redraw this for the thing. I actually drew this like right before we got on, and I knew there was a part I didn't like about it. I wanted to red across the bottom, green across the top. But I'll get that fixed for you guys. So, but what's important is as we're revolving around, right, that as we start to hit our bid, right, that means that we're actually jumping the spread, right? So that means that whatever transactions are happening at the lowest price possible, right? So this is the desperation play. If you're a long, you're fearful, right? You're taking your profit off the table. And because you're doing that, it's coming off right at the bid. You can't hold for the ask anymore, right? So lots of red fills. This also means our shorts are jumping in, right? Shorts are shorting and they're coming across and hitting the bid. This is going to help pressure the market maker down, right? And then the reverse of that for the go back. So someone asked before, and I was waiting to toggle that. So they asked me, what is the example of a good level 2? So I have LCID over here to the right, but really the only thing that we need for a good level 2 is structure, right? You want to see orders that are lined up and congregated near key levels, right? Like here, if you're looking at LCID, you see to the downside, ACB at 2750, right? To the top side, you see orders at 28, right? And then you see even distributions of orders throughout. Now, we're not necessarily going to trade this level 2 just yet, although it's looking bullish. But what you can see is that we've got good overall structure. We've got a 1 cent spread, right? We've got volume coming in. We've got lots of different things that really, really help us out. So here is kind of an example of 2 bad level 2s. The Google one was really easy. I just wanted to show you what an empty level 2 looks like. This level 2 is impossible for me to read balance on, right? To the right, all the way to the right, the Goog. Unfortunately, and it's one of the reasons I don't like trading really high price stocks. It is very, very difficult to read the level 2 on high price stocks. It's even very difficult to read the tape because the share sizes come in so small, right, that you're just not really seeing a lot there. The flip side is actually from today. Is MGI here, right? MGI has just a slew of orders in every direction, right? So this is another one where you're just going to have a lot of trouble trading it. So if you're looking to get into a trade, these are the 2 level 2s that you're not going to want to play, right? This one is all excess, right? So we're basically in a state of balance because the market maker won't need to go anywhere to transact. It'll just bounce up and down between these large order sets. And this one, the market maker is not going to go anywhere because there's nowhere for them to go, right? Either one will just chop and bounce and stay in range and not really go anywhere. Without a clear imbalance to one side, right, we have nowhere to go. So a quick time and sales overview for those who may not have had it yet. On the new DOS, it configures a little bit differently. I wanted to show you all how I configure mine. Very helpful. So yellow is going to be orders above the ask, green at the ask, white is going to be inside the spread. So like if you have a 3-cent spread, for instance, anything coming in between there is going to come. I have not done ladder. No. Red shows at the bid, orange below the bid for me. Right. So, and I just want to throw this out there. Keep in mind, all orders on the time and sales are a buy and sells at the same time, right? You're transacting with the market maker. So whenever you're seeing the orders, remember that you're seeing those orders from the perspective of a market maker, right? You're seeing the market maker's receipt tape, basically, right? So if you're seeing lots of orders coming in green, that means the market maker is exchanging lots of orders on the ask. All right. So color coding. If you pull up the main part, here's where the color coding section is. And then I also have down here, which is the filtering section. I'm going to talk about that on the next slide. This is where we're going to look and find our different tapes. So how I configure time and sales, right? So I use the time and sales and I use 3 different tapes. And I put how I filter them just below: less than 100, greater than 99, and greater than 999. So basically what I'm using these for is my smaller tape is the tape that I'm going to use to watch retail participation. So the main reason why I'm paying attention to this is I want to see what traders of my bank size are thinking. What are the retail traders thinking? Are they buying or are they selling? I have a medium tape. My medium tape is for larger retail traders and like smaller prop firms, for instance, and such. Right. So I want to see what they're up to, but they're still not really the big fish. And then my largest tape basically is looking for 1,000 shares or over. And that's your largest retail traders, your insiders and firms, right? And big players. So, and that's the tape I'm going to look for anything. So for instance, if you notice your retail tape at the top is spinning very quickly, but your long participant tape down at the bottom is not moving at all, this is going to be a very big key that your retail tape is about to trap, right? So as your big stocks are going in, right? So the other reason, Chris Simpson, good point. The other reason I have the middle tape also is when I play a higher price stock, my middle tape becomes more of the large participant tape. So like if you're playing a Tesla, you don't get a lot of 1,000 lot orders coming through on Tesla, but if you do, pay attention. All right. So now we're going to break into bullish or bearish level 2. I wanted to show you guys a really nice couple of clean examples of this. So to the right, it's a ticker for LI. LI is actually really known for having very obvious imbalance on its ladder, which is why I tend to play it a bit. The stock's in SSR in this instance. But even though it's on SSR, it looks very, very bullish. And on this day, it actually had a pretty good rally. No matter what the pattern looks like, I'm serious. Remember the mirrors. Never trade against a ladder like this, right? So this is what I mean by ladder, Abby. If you look to the top side, see how I have these pink highlights in regular intervals running up the top side? So think about this as like rungs on a ladder, right? When or breadcrumbs, right? If you the concept of breadcrumbs, right? Which is if you want to lure somebody somewhere, right? You drop the breadcrumb, or if you want to find your way somewhere, you use the breadcrumb. In this instance, I call it a ladder, right? And that's what it's more commonly called to. So when you're looking at your level 2, your ladder is the direction of the excess. So if you notice the top side, I've got 31.10, 31.20, 31.30, 31.40, 31.50. Every 10 cents, right? Every single 10 cents, there are orders there, right? So just think about this as the rungs on a ladder, right? It's anything over 50 lot. Yeah, 5K. Right. So it's wrong. So when I say don't ever trade against a bullish ladder, what I'm saying is if you see a ladder that looks like this, don't go short. Right? Because what you're doing is you're shorting against the imbalance. A market maker, just to revisit, market makers get paid per transactions. Okay? They have clients and they want to do well for their clients, but that's not where they will make their money. Market makers make money off the tens of thousands, if not millions of transactions they're going to do as they advance the price from where it's at now to wherever the target's going to be, right? And knowing that as they move and as the bulls become engaged, you're going to have a ladder develop. These are the kind of stocks you want to be looking for when you're getting ready to play a bullish play. If you're a continuation trader, for instance, and you want to play a continuation, right? This is the kind of ladder you're going to be looking for in your stock. I assure you, a long on a ladder like this, as long as your risk management is good, is going to be successful the vast majority of the time, right? Because there's an obvious imbalance here. The market maker is going to want to run this ladder to the top side. They're not going to want to run against it. The only way they will run against a ladder this strong is if like a major catalyst change happens, but it would be extremely unusual. So here's an example of the reverse, right? This is a bearish ladder, right? So when I say bearish, notice how we have orders at $15.10, $15, and $14.90. Once again, every 10 cents, right? We are distributed. This is PLTR, right? Different stock, actually kind of similar price. We get these beautifully now notice in this instance, we've got a really big stack of orders at 15 bucks. Right now, also there's a pink order on the ask side. That pink order on the ask side is coming in right at the price, right? Which means that all of our largest of orders on the sell side are really, really close to the price. Also not a strength sign, right? If you were thinking strength, you would see those pink orders to the top side. But instead, it's for condition. But because we have what I would consider a bullish level 2, I'm going to be looking for a short on this one. So wall versus a run. We're going to get into some liquidity and supply stuff. So when we're reading the level 2, one of the main things we're looking at is liquidity levels, supply levels. As we try and judge if the price is going to move up or down, having these levels are critical to continued movement up. When you play an ABCD pattern or a price breakup, what you're often doing is you're playing the momentum of one liquidity level up to another. As the liquidity at the lower level starts to run out, the price will move up or down to the next level. Many consolidations happen at these levels where large orders can be exchanged by big players at a narrow spread, right? For big institutions and traders that need to fill large orders, finding pockets of enough liquidity is essential unless you've got a dark pool, right? But that's not how we're doing this here. We're trading the live market in this instance. A market's liquidity has a big impact on how volatile the market's prices are. When these big players take positions in the market, they obviously aim to be filled at the best possible prices. However, given the size of their positions, they need to find enough counter forces to fill their orders. And here is the key: with a minimal amount of orders or with a minimal amount of slippage, if a big player were to enter at the market at an area of low liquidity, the volatility it would create would have a negative impact on the average price they get. So lower liquidity usually results in a more volatile market, and because prices can change drastically. Alternatively, if the same trader were to enter a trade at an area of much higher liquidity, it usually creates a less volatile market in which the prices don't fluctuate as drastically. Therefore, it ensures a better average price for the entire position aimed to enter or exit. These pockets of liquidity are often seen as chop or consolidation areas, right? But for us, they're not. We just know what's going on there, right? Because we have a lot of supply and liquidity, right? We're going to bounce up and down between these orders until one dries up, right? Once one dries up, we move in the direction we're going to move in the direction of wherever the excess is at, right? So if you get the target of this, what we're looking for is the L tone is locating the zones and where the price moves from one zone to the next. So we're going to be looking for large liquidity. That's where we're going to buy off of the large liquidity. We're going to let it run to the large supply, right? We're going to sell at the large supply, right? And if it holds and it keeps running, we'll add in and we'll keep selling, right? We'll keep going over and over again. All right. So liquidity levels for here, I've actually got a thermal off of Bookmap. I think this was taken around like 1:30. So at the bottom, right, you got Bookmap here. For those of you who are not familiar, Bookmap has historical and thermal L2, which is kind of fun. So as you can see, the Bookmap here, so this was taken much, much earlier. And I overlaid a shot of what the chart looked like at the end of the day, right? So notice how we have these high red areas here. Notice where we're at: 218, 218.25, 218.50, right? Every 25 cents, right, we have orders in high volume stacked. Notice if you look to the bottom, you have almost nothing to the downside, right? This is what we're looking for on our level 2. It's a little easier to see in Bookmap because of the historic, but notice the imbalance. All of our orders on Facebook were clearly to the top side, right? Very little imbalance to the downside. And because of that, if you now look starting at like 12:30, which was right around there, right? We ended up, which was right around here, right? We ended up actually rallying through that whole rest of the day and ran that liquidity all the way through up to 221, actually, all the way through that book, right? So to the right, you see Apple. And I want to show you another example of a bullish level 2, right? So Apple, this is what the level 2 looked like all day. And it just went on this beautiful run. Notice to the top side, 146.50, 146.55, 146.72 and 74, right? We've got this obvious excess to the top side. And I know if you zoomed out to 147, I just couldn't show it all. There were big orders there too. So we're trying to make a run up for 147. But as of right now, and this is one of those things, like someone in the last session I did ask me about playing a climactic reversal. Like in this instance, you can see you're pushing. So you're like, I'm so far from VWAP. maybe I should start looking for a short. No, you shouldn't, right? Because your level 2 is still very bullish. Your bulls are in control still, right? Their profit targets are above, which means they're very confident, right? Until this level 2 changes, right? And you start seeing orders to the downside, right? The bulls are all over this one. I would not take a short position until that changes. So here's the instance of a wall. So walls are a lot more nuanced, okay? And I want to talk a little bit about this. So a wall, for me, I feel like walls have a really bad convention in the way that they're named, because they're not really big. Sometimes a wall can be a large order, but not often. Normally, large orders actually gravitate the price. So normally stall points, which I think I'm going to change them from wall to stall. So instead of wall versus run, I think I'm going to start calling them a stall versus a run. So what happens is, as you're trying to move away from value or move away from the price, what you'll notice is you get basically an isolated bid. So on CCL, if you look to the bottom, and I'm going to show you this whole trade actually in a little bit, you can see we have this large order to the downside at 21.26, and there are no orders below it. And it's isolated and sitting by itself. Notice in this next chart here, this is the same one. It's just about 10 minutes further down the road after the price had dropped a bit. Notice how still we have 21.26, but we actually have orders coming in front of 21.26. This is how you recognize that you're at the bottom. As you're watching the tape, and I'll show you on the trade I'm going to review with you in a minute. As you're watching the tape and you see it start to reach and go for those orders, you'll notice that orders start to come in front, right? Like this 21.27 out of nowhere, for some reason, a market maker on a different ID is now coming in ahead of them, right? They're not putting it below them, right? They're putting it ahead of them. Why the lack of confidence, right? What's going on here? Why are you unwilling to put your orders on the bottom side of that large order? Why in front? So now as you're watching it over and over again, and it continues to go through to that order, does that order hold, right? Does it start to decrement? Do orders start to come out below it? If they don't, does that order hold, and do orders come in front? If they do, there's a really, really good choice. A really, really good shot. You're at least going to squeeze, right? Because as the short sellers, and this is what you're actually seeing, is the lack of confidence. As short sellers are starting to lose confidence, they are starting to take profit early, right? They're trying to help goad the market maker into dropping lower by throwing more shares down there, but they're not confident enough to throw them lower. Yeah, exactly. This is why you see orders start popping on and off the level too, right? These are short sellers panicking and starting to make little thought processes, little conversations. Well, maybe I'll just take some orders off here. Okay, it looks like we're stalling. I'll take some orders off here. But then what happens is it makes a new high. It makes a new high, and then all of a sudden the bulls go, oh, I see you, right? The bulls start coming in. Once the bulls start coming in, you get a buy side imbalance, right? You have a lot of buying coming in, right? And you have a lot of short covering, which is also buying, right? Once the market maker sees the amazing amount of transactions that are now hitting the ask, right, as bulls are jumping in to start pressuring the market to go up, and the shorts are covering, and if they're covering on market, they're coming out on the ask as well. This is going to imbalance the market maker alongside, right? So they're going to start moving the price upwards. Why? Because they got a lot of buys, which means they need to get sells going. So as they advance the price, short sellers cover out more, which causes more buys, right? So, and then the bulls start taking profit, right? And as the bulls start taking profit, they're selling. So now the market maker can take the sells from the bulls, flip them right through the spread, and give them to the shorts as they cover out, right? And the market maker can just revolve the price like that, and we will run right up the ladder, right? Because again, what you have happen is you have shorts covering and longs selling, and it's happening at the same time, right? So this is ideal for the market maker. The market maker can just split the spread, boom, right? We just let it run right through and we can advance very, very quickly because basically everyone's agreeing in the direction, right? Because your shorts are coming out on the ask and because your bears are coming out on the ask, bulls are coming in on the ask, right? There's only one direction for us to go, right? It's a great reversal indicator if you were selling in the first place, right? If not, it depends on the volume. So keeping with the same one here, you can see how we've dropped down. And as we've dropped down here, notice how that 21.26 is holding and it's caused the price to actually bounce, right? And come back up, right? So this is what I'm talking about. As we come down towards the larger orders, folks are starting to come in and buy in front of it. You can see the green transactions on the tape, right? So those green transactions are buying up, but it's not our bid, right? That bid's still there, right? Still being held. Agreed. Big volume anomaly too. Really, really big drop on high volume, right? Market maker imbalance, right? The high volume drop is going to imbalance the market maker already. So if the bulls can respond to that and put additional pressure on that market maker to buy, right, then the market maker is going to have to squeeze, right? Because it's just going to force them to balance their inventory and they're going to have to move price up when that happens. All right. So quick anti-bullying campaign. In many channels, it's called manipulation, but for a more relaxed approach, let's call it being a bully. Large players know that serious level people keep an eye on the level too, so they use their large bank and their margin to try and push us around and stop us out of positions. The trick is to recognize these players and to use their moves for profit, right? One method involves spoofing or using an ITF orders, no intention to fill orders as defined by Andrew's book, right? They're most often put really far away from the price, but in an unusually off size to gain attention and make speculators think there is more liquidity or supply available in a particular level than is actually there, right? This is one of the reasons I hide the CHX orders, right? Because CHX orders are always in ITFs, like 99% of the time are out of range, right? So we just cut those orders and get rid of them. But you have to pay attention to where these orders are coming in. Dropping orders is a very big deal. So as you're starting, and I'll show you that on my CCL at the end, you'll actually see a trade where I've got this. The trade I was showing you before is from the trade I'm going to review later, where you have the 26 cent. It drops towards 26, and for just a moment, you actually see orders come out below .26, and I got worried for like 5 seconds. It's CHX as a market maker, and a market maker ID. And then I was worried, but then it bought up, and as soon as it bought up, that order dropped and it came off the level 2, and I went, oh, thank goodness, right? Because I knew if they pulled, they saw it too, and sure enough, as soon as they pulled, that's when I get this really nice big rip that goes in the other direction. So spoofing is an illegal form of market manipulation in which a trader places a large order to buy or sell a financial asset, such as a stock, bond, or futures contract, with no intention of executing. By doing so, the trader or spoofer creates an artificial impression of high demand for the asset. This can happen in any direction and is hard to prove, but there are times you can see it happen, obviously. So that's the other big thing about spoofing. Prove it. Right. It's very illegal. Manipulation is very illegal, but you try and convince me that I didn't do what I wanted to do when I wanted to do it. Right. I put a whole bunch of orders out there. Maybe I intended to fill, maybe I didn't. Good luck getting them to do it. Right. Let's see. So level 2 scalping. And I'm actually, my CCL trade is actually a level 2 scalp. So I added that in here for fun. I thought my buddy Chris MC would love a little L2 scalping to close out the day. Not as good as his scalping, but I'll take it. Yeah, exactly, Chris. It's not really complicated, but basically the idea is to use the large liquidity and supply areas to take a trade. Generically, since it's scalping, I'm going to go for 2-to-1. Or something very conceivable. In this instance, that's exactly what I did. I went in at 21.32. I had a 10-cent stop, so I went for a 20-ish cent long, and it worked out really nicely. But notice here notice that 21.26 order I keep talking about. Notice how we have orders actually popping up away from the price now. So now our large orders aren't just coming in really close to the price. They are. We've got a lot of orders coming in there, but we also have orders now starting to come in above and stack away. And this is the move I'm going to look for. I'm going to look for a rip back up into the 50s, right? As the short squeeze. Oops. I'll go back. Go back. So this is another example. I meant to make this bigger, but I didn't. So sorry about that. But what you can see here is we have this large. Notice I went short here for a breakdown under S3. Look how heavy the level 2 is. All right. Let's see here. Okay. So this is my my trade example on CCL. So it probably take me 5 or 10 minutes to go through this. And then if we have a couple of minutes, I can answer a question or two if I manage to get to it. So I want you to look at CCL right now. So basically, this is a 45-minute trade, basically, that I'm going to condense down into like 10 minutes by fast forwarding. So, but I want you to see here the 2155 and 2150, right? We've got in the moment, we have a fairly obvious imbalance to the downside, right? We've got large orders at 2155, large orders at 2050, and probably larger orders below. Now, I'm not looking to go short necessarily yet because we're already at S3, and I don't short at S3. If anything, I long at S3, but I'm not willing to go long here. Why? Because the level 2 is bearish, right? I do not trade against a bearish level 2. And since I have this large congregation of orders, most of my transaction on the sell side is happening at the price. I'm going to continue to wait. All right. So as you can see here, 2155, it'll pull the price in just a second. Nope, I'm not going to short this one. I'm actually going to long it. So I'm not going to short it because of where I'm at. I'm at S3, which means I'm in a low. See, if I was at R3, I would have shorted it. But I'm at S3. So I'm too far down in my range. So I'm not going to short here because I don't really have any faith of how far it's going to go. Right? So, but what you can see now is we've ran down into 55 and look what happened. We got more orders below at 50. Chris has already got his first partial. Out of bring it. So now look, now we got 2146. We had 2126, that isolated bid to the downside. Right? We'll go ahead and speed up a little bit to get into them. All right. So here we are. Now, notice now we drop down into all of those really big bids, and we've got our 2126 here and this 2137. We'll come down and get the 2137. Now, notice the VPA anomaly that just occurred, right? We had a large sell with a lot of volume, and that's good. But if you look overall, I mean, that is a very, very large sell. I wouldn't call it climactic necessarily just because it's equal to some of the opening volume, but it's certainly out of place, right? It's certainly very large volume. Right now, the level 2 still bearish, right? So, but I am noticing that we're starting to get some recoil. Look, these are, all right, pause. Hold on. These are bulls. See this 73 and this 51 at 2144 and 2146. These are bulls, right? So these are folks like Chris MC, for instance, who are going to buy this extreme dip, right? He's going to come in and go long. And when he goes long off of this high volume bounce, he's going to throw orders out really fast. And this happens on a very large scale as well, right? So these are orders that are coming out above. There's no reason for a short seller to advertise that they want to put more short in here. The only one who has an advantage here is the bull, right? The bulls are buying in right here and they're saying, go here, right? Boom. So they're in. So you can see their orders now stacking top side, right? And this really kind of gives us an indication that maybe we're going to stall, right? We don't have larger orders below here because I had already searched, right? Now we've got 2133, 2137, also pretty loaded up here. Let's see if our bulls drop. If our bulls hold, look, we just lost some bulls, but they're coming. We just lost some. They dropped. They had to stop out. See how they went away? Now look, more bulls popping up to the top side. Right? So someone's buying as we're dipping in towards these large numbers. Now notice, look, there it is. There he is. Notice when we went down into 37, something unique happened. Orders came out right in front of that held bid at 26. Right? So we now have started to clear our downside ladder, and we are starting to congregate an isolated stack right down here. So we've got our big volume bar, our big 1 minute bar, right? And we've now got a held bid that we're stalling in front of. It's still not a long for me yet. It's still right here. You can still see them. But notice how we keep getting these flurries to the top side, these little pinks that just appear. We've got bulls buying again. So there's a lot of buy the dippers here that are trying to get in. You can see them. There they are, right? They come in. You just see their orders fly in really quick. This is a 5 minute chart. I should have a 1 minute. I have a 1 minute. You can see the tail of the 1 minute chart right over here. So with these holding so well, I'm going to keep an eye on them as a target. But if I see a lot of buying start coming in and a lot of covering, look, there they are, 2138. See, I'm seeing orders starting to pop to the top side. So even though we're still selling, oh, look, there's my panic spot. This is where I got nervous. Right? This is where I got nervous for just a minute. All of a sudden, I noticed we were starting to push down. Now, I'm not in a position yet. So this is where I was starting to think, oh, wait, this thing might sell more. I was getting ready for a long, but I was like, man, this thing might actually sell more. Look, we've got orders coming out below. And I was like, oh, man, that's just not good. So I'm waiting. And now I'm not going to go long unless 2122 pulls, right? Which means I want to see their orders come off the book. Now we have big volume down. We have a small volume consolidation on the 5 minutes. So this could actually go the other direction, but I'm still waiting to see here. Now, here we go. All right. All right, we pulled away. We're pulling away from the bid. There's 2126. All right. So 2126 at this point is still holding strong, but notice something has started to happen. 2122 is decrementing, right? So it's no longer as big. It's no longer highlighting. It's getting smaller. So that order coming off is kind of starting to see 32. Someone's taking, they put orders below, but they're covering too early, right? They're not holding strong. There's a lack of confidence. This order is decrementing. So whoever's holding this position, not very confident about. Look, 22 again, now another 10 lot down, right? 22, another 10 lot down. 22, building a little bit. Look, as we're pushing down, the short sellers are kind of coming back in a little bit. But over and over and over again, I just see this 22 just does not look that strong to me. Oh, look, 18. It's decrementing again. 34, back up again. As it pushes down, we're putting in here. So I'm just constantly watching, and this shows you guys how long it takes for the right condition to set for me to see the information that I really want to see here, right? To get into a good position on this thing. So now that it's been holding up for a little bit, and I've noticed that we're still decrementing and we're just not building downside strength at all. Let's see, I'm going to let it break. And when it breaks, it goes to 27. A lot of buys come in at 27. I see the top side load. And that's where I take my position. So I saw it lunge for 26, and it didn't go to 26. Rather, it held right in front of it. And I saw a lot of orders come in on the tape in front of it. Right. So because I'm seeing that happen, I now know, right, that I'm feeling very, very confident. My 21-22 order is still gone to the downside. It never came back. Right. I've got bulls starting to load topside a little bit on me. Right. And I'm in a really nice spot. Right. So I'm long here. I've got about a 10-cent stop. So I'm only looking for about 20 cents topside. Right. I actually set an order, a range order. 21.50. That's still fine for me. That's still way above what I was worried about. Here we go. All right. So now you can see here, and you're going to see all of the orders are going to start to come in really tight as you'll see a flurry of green. There was 5,000, but you'll see a flurry of green come across as the shorts start to cover out and the bulls start to come in. And when that happens, this thing just, yeah, I record all my trades at all times. Come on. I don't want to miss that part. So watch the time and sales. Notice how when we get red, right? So hold on. There's a really important nuance here. Notice how on the time and sales, this is a really important nuance. All right. When you're looking at the color, okay, if you see red and the price doesn't sell, right? Then you're not then it's not hard sell. You know what I mean? It's not showing that. But if you see the red and the price goes up afterwards, that what means your bid's getting hit on limit, right? And your ask is getting hit on market, right? So that normally means you're getting some buys to come in, and the buys that are coming in are coming on the top side. Anytime you go down or your sellers try and take profit, it immediately buys up, right? So, and we've got imbalance to the top side right here. That's set in. Now what I'm not liking still is, look, 21.26 still holding. So it's sold down and it bought up, and I felt really good about that. But at this point, I was kind of like, man, I don't know. Luckily, I felt pretty good because I'm hiding behind 21.26, but I was not very excited to see all of these start to load downside like this. Luckily, my held bid. So, and that's why this is called a wall versus a run, right? Because 21.26 is acting as a held bid, right? So this is our order. Now watch, the level 2 leans, right, as the bear, look at all the bears are covering out and taking off. Boom, right? So now our ladder is starting to lean out real quickly. And when I first got into my position, by the way, the ladder looked very lean and I had orders to the top side. It actually flipped back to bearish in the middle. But when I got into the order, man, it takes forever to get to this trade. It's so funny how it just shows how long it takes to wait to get to these trades. And then when they finally work, it's just so quick. All right, here you go. Watch. As we finally start to break and make these new highs, look at the flurry, right? We get all the green to start to come in. That's as we're hitting the ask, right? Bulls hitting the ask, shorts covering. bulls are chasing, right? Now you have your large lots are actually chasing up as we're going through, right? And your sellers were pulling away. So, and then boom, you get the pop up like that. So, and then in this instance, I was all out. So I did a scalp on this one. So I was just going for 2-1. Because of the loaded bid, I actually wasn't expecting a big break. But this shows you this trade is a 45-minute setup, right? So it takes, like 5, 10, after I see the big candle, 5, 10, 15, 20, 25, 30, 35, 40, right? It takes a really long time for this to set up, right? Constantly looking at the level 2, constantly looking at what's going on and trying to figure, hey, what's going on and seeing the signals we want. So this is kind of what I mean about where, when, and how. This is why you have to have a defined area to look for a trade, but you need to have a defined reason or expertise to get in. So I hope everyone had a great day. That is my session for the evening. It's 9 o'clock. I really appreciate everyone coming by tonight and hanging out with me. I hope everyone had a great evening. And as always, keep it green, y'all. Thanks.